Okay, let's move on to our next section here and talk about long-term financing. Long-term financing is basically borrowing money, and this is the bond market for large corporations. So they go out into the public markets and they issue loans. Loans are another word for bonds. In fact, there's several different words that we can use for the long-term financing or the loans or the bonds market. We often call it the credit market. We also call it the debt market. So it's debt, it's credit, it's bonds. Basically, we're talking about loans. So when we think of bonds, maybe you've heard of a bond offering at your local school district or water district, and they want to do a bond offering. What they essentially say is we want to borrow money and we want to pay it back over time. So corporations obviously borrow lots of money, billions and trillions of dollars, and so we have a huge bond market that we have to understand. So in this section, we're going to go through how to price bonds, how bond prices move with interest rates, and so on. So if we look at this, besides the bond market equaling the credit market, equaling the debt market, if we go beyond that, we find out what a bond actually is. So a bond is basically a contract. And when we think of bond as a contract, we know that the contracts need to be standardized if we're going to trade them. So the contracts are uniform, all of the terms are known, and they get traded in the market. If they're not uniform, they get traded what they call over the counter, and that's a whole different scenario. We're talking about just regular bonds that are traded all over through the brokerage firms back and forth to all the different investors out there, and anybody can get into the market and buy bonds. So there's some factors of bonds. A bond is legally binding agreement which has a par or face value. That is the amount of money that was originally borrowed. $1,000 is the value we will be using in this course. It is typically the value of one bond. One bond is $1,000, and if you want to borrow $10,000, you would issue 10 bonds. So each bond is worth $1,000. That way they trade in $1,000 units. The coupon rate is the interest rate that you would pay for loaning the money or that you would receive if you had loaned the money. The coupon payment is the actual amount of the dollars that you will receive. So if the coupon payment was, first of all, the coupon payments in this course and almost always in bonds are every 6 months. So there's 2 payments per year. We will do that in every problem, 2 payments per year. So if the interest rate per year is 10%, the payment per period would be 5%, and 5% of a $1,000 bond is $50. So every 6 months, if you owned this bond, you would receive a check for $50. That is the way a bond would work. The maturity date is when the loan comes due. So at some point in the future, the loan comes due and they have paid all the interest to date, and then all of a sudden they have to pay you your money back. So bonds in the corporate way of looking at loans, corporate bonds are interest-only loans. They pay interest only until they pay your money back, which is at the maturity date. And we'll talk a lot about maturity here. There's a term called yield to maturity, which is the required market interest rate in the bond. The yield to maturity is what changes when the current interest rate is different than the coupon interest rate. That means that the interest rate now in the market is different than when the interest rate was issued, or when the bond was issued. So if the bond was issued 2 years ago and interest rates have changed, the initial interest rate will be your coupon rate, and the new interest rate is your yield to maturity. Do not confuse those two. That's going to be a problem. Going beyond that, the primary principle of bond valuation is the value of the securities is the present value of the expected future cash flows. This is the same with stocks and with just about everything else. We want to find the present value of all the future cash flows discounted back at whatever rate is appropriate. So, therefore, the bond is determined by the present value of the coupon payments plus the present value of the par or face value or the amount that you're going to receive at the end when it's paid back. So the par or face value is the original loan, and whatever you're going to receive at the end of the term is what you're going to think of in your calculations to figure out the present value. Interest rates are inversely related to bond values or bond prices. So we're going to go over this quite a bit. They basically move exactly the opposite. So if your existing bond it was issued at 5% and interest rates now, the time has gone by a couple years, and interest rates have gone up to 7%, the bond price will be lower than what you paid for it. So we'll get into that more in a few slides, but this is a big principle in bonds, that bonds move inversely to interest rates. When I say bonds, I mean bond prices. Bond prices, the value of bonds, move inversely to interest rates. Huge concept there. So the one slide here shows you the cash flow of Xanth Corporation. It's issued a 10-year bond with an 8% annual coupon. The cash flows from the bonds will be paid annually. Now this is an annual coupon. Our class is going to have all semi-annual, so it'll be every 6 months. So you have to cut these in half. But it'll give you an example of what's going on here. This is from your textbook. So for first year you get $80, second year $80, third year $80, blah blah blah, all the way down to the last year where you get your last interest payment and you get your $1,000 back. That's the way bonds work. The only difference between this chart and the ones that we will use in our problems are we will have 2 payments per bond. So instead of one $80 payment per year, you will get 2 $40 payments per year. And that's the way all of our problems will work in bonds in this class. So that gives you an idea of how the cash flow works. The corporations get to use the $1,000 for 10 years. They pay you some interest on that. That is money taken away from shareholders. That doesn't go to shareholder profit. That is an expense to the company, and they get to write it off. And of course, bondholders have to pay taxes on the money that they receive in the bonds. So we're going to go through some problems here on how to price these and so on through the bond section. But remember, all bonds are a loan. You're paying it back, you're paying interest only, and you're paying it over a set period of time, and at the end you get your money back. And that's the way bonds work. So let's keep going.